Thanks for staying with us on SABC News. Nedbank recorded an 11% rise in interim profit as it gained from higher interest rates even as its bad loans grew. Nedbank's credit loss ratio, a measure of bad loans as a percentage of total loans, was at 121 basis points. This was higher than the 85 basis points it posted a year earlier and beyond its target range. According to the bank, the operating environment in the first half of the year was much more challenging than initially forecast. Nedbank CEO Mike Brown spoke to SABC News on the company's results.
We've got almost 0% GDP growth, and both interest rates and inflation higher than anybody thought they would be. Thankfully, inflation starting to trend down. So against that big picture backdrop, we were certainly very pleased to report what we feel is a solid set of interim results. Headline earnings up 10% and improvements in both our return on equity and our cost to income ratios. We saw strong revenue growth of around about 14%, disciplined cost growth at about 7%, and that was offset by a strong increase in impairments or bad debts, with the credit loss ratio rising to 121 basis points, almost exclusively in the consumer segment in retail. So if you look across our portfolio of businesses, we saw roughly 2% growth in CIB. We saw an 8% reduction in earnings in RBB, or our retail business, primarily from that increase in credit losses, and then very strong growth in both our wealth businesses and our businesses outside of South Africa.
With households, experiencing a deterioration, in finances, and as a result, relying on having to use up their savings to sustain their living standards, so to speak. What are you seeing when it comes to household credit demand, and perhaps let's end in there corporate credit demand?
So clearly, households are under a lot of pressure in the current weak economic environment. They've seen increases in loan repayments and increases in essential expenditure. Think of food, fuel, schooling, etc., well in excess of inflation, which all eats into disposable income. As a result of that, we see on the one hand that increase in bad debts that I spoke about earlier, but we've seen relatively muted growth in our consumer lending businesses, somewhere around about 6 or 7%, so roughly in line with nominal GDP, if you think of inflation at about 6% and almost no GDP growth. And then on the wholesale side of the business, a relatively mixed performance. Very strong growth in anything to do with energy, and Nedbank has a very strong pipeline in what we would call commercial, industrial, renewable energy generation, around about 2 gigawatts of power currently under construction, 13 billion rand of loan opportunities behind that. But beyond energy, mostly corporate South Africa has pulled back on essential investment other than what is required for their businesses to remain competitive. We really need an environment where we see new investment going into new factories and new mines and the like, but that's unlikely to happen while we still don't have energy security.
For the benefit of our viewers, take me through what you're seeing here from a credit quality perspective when you incorporate the negative impacts of load shedding.
Yeah, so certainly we saw a strong increase in what we would call impairments or bad debts. They were up 57% in the first half of this year, and our credit loss ratio increased to 121 basis points. So that's how much are we writing off or providing for bad debts for every 100 Rand we lend out, 1.21 Rand. A year ago, that was 85 basis points. And the last time we saw levels around about 120 basis points were in COVID, where it got up to well over 180. But before that, you have to go back to the global financial crisis, where credit losses were somewhere between 120 and 140 basis points. So there's a lot of pressure in that environment. We hope that it will get better in the second half of this year. There's always some seasonality in retail bad debts, but also we see inflation starting to trend back down again. In particular, from load shedding, we're seeing impacts in the agricultural sector and the horticultural segment within that in particular.
The one thing that I found interesting, and that's just a recent one, is in July, about 111 of South Africa's leading corporations participated in what we call the CEO's Pledge. For that to have success, or for the success of that partnership to have traction, what will it hinge on?
Well, I think what it's symbolic of is that the CEOs of many leading businesses in South Africa undoubtedly believe in the economic growth potential of our country, but are concerned at our current level of underperformance relative to that potential. Some of that as a consequence of global challenges, but a lot of it as a consequence of our own domestic challenges. And we really want to focus in on three key issues: energy, transport and logistics, and crime and corruption. And we think working alongside government in trying to resolve the challenges that we face in those three areas could add as much as 3% to GDP in our country.
As we wrap up, what's your outlook going forward if we incorporate conditions in the banking industry as it stands?
Well, we certainly think that the second half is likely to remain difficult, both for the South African economy and the banking industry. We were very pleased with our H1 performance, or our half-time score in the full year game here. So we would hope to be able to deliver similar performance in the second half of the year, aided by a slight reduction in bad debts.